Brad Williams, Frugal Finance. Why yields for the same maturity differ. Frequently, we observe that two U.S. Treasury bonds with the same maturity have different yields. Keep that in mind, different yields to maturity. Can this be a violation of the law of one price? And you're going to ask, what's the law of one price? In finance, you have to follow the law of one price. What am I talking about? Remember I mentioned about equivalence? Well, that's essentially the law of one price. If we're not equivalent, if we're not following the law of one price, arbitrage comes into play to make sure if there's any discrepancy between, let's say, a 5-year bond and a 10-year bond and its pricing and its yield to maturity, the market will correct that to make sure that they're equal, that they have equivalence. Without getting too deep into the law of one price, it's called parity. We work under the rule of parity in finance in order to avoid arbitrage. And there are now systems out there, computer systems, that will identify and take advantage of any discrepancies in the way of arbitrage within tenths of a second. In the past, before computers were in place, individuals would focus strictly on arbitrage opportunities, be it in futures or bonds or stocks or currencies. Currencies, it's huge. You would basically print free money because arbitrage is an opportunity to identify a situation where there's zero risk and all you do is level the playing field. Can this be a violation of the law of one price? That is different pricing for the same maturity of a bond. The answer is no. In fact, for bonds with different coupon rates, the law of one price implies that unless the yield curve is flat, bonds of the same maturity will have different yields to maturity. Did you catch that? Unless the yield curve is flat, bonds of the same maturity will have different yields to maturity. Well, first and foremost, what do I mean by a yield curve? Well, traditionally, without me having to put together a chart, we look at 1-day funding out to 30-year funding. In a typical yield curve, just visualize this, we have, say, 4% here for 1 day, and then out to the 30-year, it goes up to 7%. So we're going to have this slope. It's called a yield curve. I'm not going to draw anything here. So just think 4% to 7%. In between are going to be whatever the market thinks the rates are for a 1 year, 10-year, a 5-year, 10-year, 20-year, 30-year. They used to go all the way up to 40 years, not too long ago, for treasuries. When you talk about yield curve, when it's flat, that means it's flat. Here, we go from 4% to 7%. Not often you're ever going to see a flat yield curve. The general rule then is bonds of the same maturity will have different yields to maturity. For example, consider two different 2-year coupon bonds. One with a coupon rate of 5%. Coupon, that's the printed rate. That's on the face of the bond. And the other with a coupon rate of 10%. Suppose the current market price and yield of 1 and 2-year pure discount bonds are as follows. We have this 1-year and 2-year. So we're going to use 4 and 6% market price. What are we trying to do here? Again, coupon is 5% and 10%. The yield per year is this number, 1.0961. What's this 1.096158? It is this number right here, the coupon. All we're doing is taking 100 divided by 1.04. Then we're taking 100 divided by 1.06 to the 2. So this is the 1 year, this is the 2 year. Here's the price. If you really want to know how it's broken down, the pricing will be in 30 seconds. Keep that in mind. Remember I said the 16th of a point. In bonds, it breaks down to 30 seconds. Here's the price, 96.492 by 32. Here's the price, 961.54 and 890. According to the law of one price, the first year cash flow from each coupon bond must have a per dollar price of 0.961538 right here. That would be this 96 and 492 30 seconds. And the second year cash flows must have a per dollar price of 0.88996. So the market prices of the two different coupon bonds should be market price, okay? So 1 year, we have a 5% coupon, remember right here, 5% coupon at our price is 0.961538 equals 961538 times 50 cash flow for the 1 year plus 88,996 times 1050, second year. Our pricing is 982.53, producing a yield to maturity of 595. Then the 2-year 10% bond at 8896 is equal to 96158 times 1 plus 8896 times 1100. Notice the only change here is 1050 versus 1100. This is selling for 107.550, producing a yield to maturity of 591. Yield to maturity. Again, we're going to use this old school deal here. We're going to take 982 is equal to 50, so on and so forth. Again, we're just going to use this trial and error method. All we're doing is going 98257. Now you can narrow this down if you really wanted to the 595 something something something, but this is close enough in 591 to 107.5. So we see that in order to obey the law of one price, the two bonds must have different yields to maturity as a general principle. When the yield curve is not flat, which is most of the time, it's inverted right now. This is the middle of July 2024. And short-term rates are higher than long-term rates. Why do you think so? I'm going to let you think about that. Comment. Let me know. When the yield curve is not flat, bonds of the same maturity with different coupon rates have different yields to maturity. Think through this one. Fixed income is very complex. This is just an introduction as to the complexity of bond pricing and understanding coupons and discounts and zero coupons, bootstrapping, and continuous compounding. We haven't gotten into that yet. We're stepping into this slowly, but we're going to walk into some complexity that if you're not grasping this yet, keep working through it. That means backwards and forwards. You really need to understand how the discounting works and why we're using different numbers, why the pricing is the way it is. Notice we're working in 30 seconds. We're going to have this coupon. We're always going to have yields. And so it's just a matter of siphoning through, feeling comfortable with the structure. And the structure is the math. So here we have one structure, which is Excel. And then we have this other old school. Whatever works for you. Doing both doesn't hurt. Brad Williams, Frugal Finance. See you soon.